when you look at a strong economy, a still tight labor market, although seeing some softening there. Same thing when you look at, when you look at the labor market, and when you also look at some of the wages that we're seeing as well. But then on the other hand, you have oil prices continuing to potentially fuel inflation even higher. What do you do for your portfolio? How do you really manage some of the risk here?
Yeah, no, I think everything you just described, it just makes investing more interesting and definitely confusing for investors. And that's, just narrow it down to the US. If you extrapolate this to the global, investment opportunities, it's actually even more confusing. So, to your point, what we are in this part of this, we have been discussing, and people have talked about recession for now 18 months. And we have been on the camp of this rolling recession area when different parts of the economy have actually gone into recession and started to go into more like an earlier recovery. When you even think about housing, when you think about manufacturing, when you think about some of the, goods parts of the economy going into pretty, significant deceleration last year, but recovering early already. So we seem to be more in this now rolling recovery for some sections of the economy. As to your point, the U.S. economy is still fairly resilient, it's still growing, and then it's still on the heels of supported by the consumers and a tight labor market. Now, what that does is that creates these, race towards getting the inflation down, and at the same time having the deceleration of economic activity, not necessarily to create an extra inflation that is sort of what the Fed fears. On the other hand, when you actually see about anything that points out to the conditions that we have, rising dollar, rising interest rate, tightening credit conditions, higher commodity prices, and inflation, core inflation particularly, that is the one that the Fed watches, is still fairly elevated, that will point to a significant deceleration. So to answer your question, what we're exploring and discussing with our clients is this barbell approach, where you still have to have a portion of your strategy to be defensive in preparation for what may happen regarding a potential recession, which, while may not necessarily be a pretty deep and long recession, there's still a possibility that with these conditions that we may actually have a significant deceleration of the economy and inflation that stay high. And therefore, staying in areas that have higher quality, that stay in free cash flow that is consistent, higher earnings, quality, those are type of companies that you want to have in your portfolio. At the same time, because of these rolling recoveries of the economy, we may have a situation where parts of the market may already be in that early cycle where you actually want to have exposure to technology, you want to have exposure to financials, you want to have exposure to those sectors that tend to do well after you hit the bottom of the economic cycle.